The intersection of geopolitical fragmentation and AI-driven attack surfaces has transformed defense and cybersecurity from niche sectors into an indivisible megatrend. For the serious investor, this represents a structural shift where nation-states and enterprises treat security as a non-discretionary survival imperative rather than a cost center. The filtering logic used to identify winners in this space moves beyond speculative disruption, focusing instead on structural oligopolists. These are firms characterized by entrenched positions in multi-billion-dollar long-cycle programs, robust free cash flow generation, and technological moats rooted in classified integrations. This elimination protocol prioritizes capital discipline and pricing power over unproven unit economics. Lockheed Martin, identified as the Kinetic Deterrence anchor, exemplifies the structural moat through its dominance in the high-end weapons systems value chain. Its primary engine is the F-35 sustainment program, the largest in history, which creates a classified integration flywheel. This cycle of proprietary platforms and long-term prime contractor relationships is nearly impossible for competitors to replicate without decades of sunk R&D. Financially, Lockheed guides for free cash flow between $6.5 and $6.8 billion, with a return on invested capital in the low to mid-teens. This cash supports a disciplined strategy of dividends and buybacks. However, the bear case rests on execution risks. Supply chain issues or cost overruns in flagship programs like the F-35 could trigger margin pressure, especially if defense budgets face sequestration. RTX Corporation serves as the integrated systems powerhouse, offering a diversified fortress across missiles, radars, and engines. The synergy between its Collins Aerospace and Raytheon Technologies divisions creates a unique dual-use technology moat. With recent trailing 12-month free cash flow exceeding $8 billion, RTX maintains a balanced profile, though its ROIC typically sits in the mid to high single digits. The primary risk for RTX involves integration complexities from its merger and potential headwinds in the commercial aerospace sector, which could dilute defense-driven margins. Together, these kinetic primes provide a foundation of backlog-backed predictability essential for any long-term allocation in the defense sector. CrowdStrike represents a shift toward digital defense, operating as an AI-native endpoint and identity fortress. Its Falcon platform utilizes a cloud-native detection and response system that consolidates multiple security modules into a single agent. The core investment thesis here is the data flywheel. As more threats are identified, the AI's compounding advantage increases, creating high switching costs for clients. Unlike the hardware-intensive primes, CrowdStrike exhibits explosive annual recurring revenue growth and high incremental margins typical of subscription-based software. While it generates significant quarterly free cash flow, the bear case is tied to its valuation and execution. The stock is priced for perfection, meaning any platform outage or a failure to maintain a technological lead over competitors could lead to violent multiple compression. Furthermore, the company's GAAP variability necessitates a focus on its cash flow and market share gains rather than traditional net income. The final portfolio architecture for a long-term investor involves a strategic allocation among these three assets to hedge against both kinetic and cyber threats. Lockheed Martin functions as the core anchor holding, providing a reliable, moated cash engine and dividend ballast. RTX serves as the diversified bridge, offering broader industrial leverage and subsystem depth across both military and commercial sectors. CrowdStrike is positioned as the high-beta tactical satellite, offering asymmetric upside from AI tailwinds and digital transformation, albeit with higher volatility. This comparative verdict balances mature cash cows against high-growth compounders. The logic is clear. Defense names provide budget certainty in a fractured world, while cybersecurity names capture the secular trend of global digitization. The payoff for the investor is a structured exposure to global resilience. By following this framework, a portfolio is fortified against existential risks, whether those risks originate from physical conflict or a cascading digital breach, without overallocating to speculative players that lack the scale or unit economics to survive long-term cycles. This trio offers a rational path to capturing the defense megatrend through established moats and proven capital flow.